Да, как я уже сказала ранее, мы представляем Нитина Гаура, директора IBM по финансовым услугам и цифровым активам. И сегодня он нам сделает такой экскурс в криптоактивы, расскажет про его профессиональное видение всей этой ситуации. Ну и нам, конечно же, интересно, потому что ситуация с Центральным банком и позиции по управлению криптовалютой добавляет интерес ко всей этой ситуации, подливает масло в огонь. Поэтому я передаю слово Нитину. Презентация сегодня будет на английском. Я передаю ему слово. So, Nitin, thank you. I'm giving the word to you.
Okay, no, thank you. Can you allow me to share my screen?
Yeah.
But thank you so much, Olga and team. I'm sorry we had some timing confusion. Maybe that's the various time zones, and but we are here. So really happy to be here. Really glad to be able to present to this team. And I think I still have disabled sharing.
Just a second.
Yeah, and I prepared a presentation, but the objective of today's call, while Olga is trying to fix the screen, I think now I can. I have prepared a presentation which has 3 sections. I think generally I don't want to directly jump into more advanced topics. So I figured I'll start with some basics and paint the picture of how does a token and crypto portfolios get their value. I think it's a very misunderstood concept where you find these crazy stories of 200,000% and 200% and 1,000% and 60%. Which in traditional markets is not the case. And there's a technical reasons for it. And I just wanted to sort of share what that means. How does a token get its value and what should be the traditional valuation mechanisms? And I'm just going to present my journey. Besides I'm working for IBM in terms of financial sciences and digital assets, I also work as a research analyst for a portfolio management company which deals with DeFi, which is crypto assets. And I have a weekly podcast where we discuss some of the macroeconomic conditions and some of the technical issues that is affecting. So please connect with me on LinkedIn. The podcast is beyond Bitcoin, which means we look into the entire industry holistically and bring some thought leaders in trying to understand the space, because there's still a long, long way to go from this perspective. But before I go further, I just, 3 parts. The first part, I'll talk about what is tokenization. And it's important to understand because it's oftentimes misunderstood, but it's a simple concept. And then we look into application of that tokenization. How does tokens connect to each other in that ecosystem of, let's say, Ethereum and ERC20, ERC721. You have layers and layers of token that's built, and each system has its own economic model. The question is, how do we understand the valuation and the interlinkages of those valuation as these ecosystems evolve? And that's what, and the third part is giving you some application of data and AI. It's what me and my team have done, is applying data analysis in understanding the relationship between the various tokens. There is a method to the madness. So if a value goes down, that value of, let's say, Bitcoin and Ether or any of the layer 1 protocols has downstream effect on the increase or decrease in value of other assets that may be in that ecosystem. So a few things, right? Tokenization is not new. We have looked into tokenization. You look into when you go to amusement park or when you go to movie theaters, you get a piece of paper, and the paper either, if you go into a movie, it gives you a rights to watch a movie and enjoy it. And if you go to a amusement park, a token gives you a right to be able to go to different rides. So it takes away a few things. It takes away the complexity. You cannot, giving you a pass or giving you a token takes away the ability for you to transact with every single ride in a park, or giving you a token gives you digital rights to access a few things. In technical terms, when you accept a cookie and you have your authentication token, it gives you that token and removes the complexity of logging on to every web page, because that token represents you and your authenticated information as you go through different subsystems of an application. So tokenization is old. In fact, it's very old as we look into it. And it provides some basic fundamental benefits before we go into digital manifestation of what that token would be. Is it provides, one, it's ease of storage. You having a token or a boarding pass, or it takes you away from begin to show 100 different elements, because a boarding pass means that you have paid for the tickets, you have been authenticated, they've checked your ID, they've checked your international visa and documentation, and boarding pass makes it easier for you to go through multiple airports without actually having to show the complexity of these things. Same thing with you carrying a bunch of tokens or a pass and going to amusement park, you simply scan your pass or use those tokens. So it takes away from a lot of complexity of a lot of transactions or micro transactions that you may have to do at every different points. And in many cases, this becomes the foundation of a new business model that we have begun to explore in the digital space. So when we look at digital tokenization, we are trying to take the exact usage of what we have seen in the existing world and look into benefit of tokenization. And this is where I think many projects, in my opinion, at least in the enterprise world, have failed to understand some of the intrinsic ability for us to look at tokens. It's not just ease of transfer and as opposed to physical transfer, which is what you see in the crypto world with gold and with some of the physical commodities and trade finance. We begin to see it's not only solving the issue of tokenizing a few things and obfuscating that information and using that mechanism to pass information back and forth, but it also has a lower cost and increase in speed. And one thing that we have always said that blockchain solves the issue of time and trust, that there's a lot of money and energy and business processes and systems that go in, paying for the ability for us to be able to go into solving the issue of time and trust. So either you're trying to compress time and there's some third party that's providing liquidity in case of global transfer of money, or there is some party that's giving you a short-term loan because you're going to get your money in a trade finance scenario 30 minutes, 30 days from now, or 90 days from now. And there's a cost of doing those things. So many of these things are in the digital world, what we're trying to do with blockchain is, by blockchain provides a universal transaction system, we are trying to use smart contracts to automate, enforcing behaviors around tokens, which reduces fraud, and which means that it reduces the need for a lot of intermediaries, a lot of middlemen who provide verification validation services. It also gives me the ability to fractionalize the transfer of ownership, which you cannot do in the real world, including the real world tokenized systems that we've looked into, is ability for me to take a fraction of my identity, or fraction of my healthcare record, or fraction of my gold, and monetize it. Not to mention some of the ability for us to be able to, if I take one token and create 100 transactions or 100 fractions, the sum total of all those fractions should still be that one token. And that's easily done, naturally done in blockchain space, because blockchain maintains provenance and transparency for all the information that we keep in a single space. So that is the foundational element of what tokenization is. So I don't think we should overcomplicate this from a perspective of when you hear that this is a token and that's a token. The question then becomes, how does a token get this value? So for example, if I have a token that represents gold, does the token only represent the value of gold, which means we have digitized gold, or does it also have the potential value of the ecosystem that the gold will represent in, whether you're using the gold for payments or whether you're using gold for, so you have many such use cases where the easy path is to say, if this token represents nickel or gold or any other precious commodity or diamonds, then we can assign the value of the diamond. But I believe that all these cost structures of lower cost, increased speeds, removing middlemen, using a token and speeding up the transaction systems have much more cumulative value than simply equating a token to something of its, of what it represents. And in case of Bitcoin and Ether and many of the layer one protocols, it represents an ecosystem. It represents the trust, which in Bitcoin's case, it's been 13 years that that system has been accumulating, and that the cost of Bitcoin today is reflective of the trust that people have in the system. But also the ability that the fact that it's 13 years and several thousand kilowatt hours of energy has gone into securing the integrity of that token. All that is leading to the cost structures behind Bitcoin. That's an example. Of course, in case of Ether, you'll find that the ecosystem that it represents has more valuation. And that's what we're trying to understand. That's what hopefully at the end of this session, we provide some methodology that gives you a perspective of understanding what that means.
Nitin, sorry for interrupting. A small organizational issue. Can you give me a right of co-organizer?
Okay, so let me see how I can do that. Participation, Olga, more, make it co-host.
Yeah, co-host.
Okay, you should be co-host now.
Yeah. Thank you. Sorry.
Oh, this is people coming in. So it is. Okay. So application of it, right? This is where I have spent the last decade in trying to understand some of the elements of value proposition of tokenization in blockchain. Whenever I design a system, and it's a difficult challenge for enterprise because enterprise is trying to reinvent its business. That is usually a closed system. But the value proposition of tokenization in blockchain is revolving around three different constructs. One, what is an asset? And that's something which I ask every single time if I'm talking to a bank or shipping entity or some organization to say what gives token its value and what is a real asset. The asset can be a shipping container, asset can be a patent, asset can be anything, but we have to define as to what gives that asset its value. Super, super important element. Second thing is when I'm creating a digital representation of ownership of goods and let's say digital rights, and this is what we have been seen with NFTs, and happy to answer some questions because that space is super exciting, super complicated in terms of what does an NFT give you? Because in many cases, anything that's digital can be copied and pasted. What is the element of valuation that in that model and the process itself? So if all I'm doing is creating a token, then I don't think it's doing the justice, the ability for me to create a token with the right technology choices that not only preserves value, but has the ability to transfer value, which means I'm looking at asset bridging. I'm looking at the process of how do you convert the rights and how do you preserve the rights, whether it's tying to a physical asset or tying to a digital asset. So these three things should be on anybody's mind as you're evaluating the space, whether you're a solution architect working with a bank or working with a shipping company and working with central banks, or you're simply a individual who is trying to understand this from trading perspective and understanding what token gives value. Simply don't go on the social intelligence, which is the mean value of a token. Try and understand these three elements: is what is an asset in the system, what is a token that it represents, because some systems have two tokens. One is a governance token, one is actual digital assets. And governance token by definition should never exponentially increase in value, because the whole element of governance is voting and ability to maintain a community-driven decision process, as opposed to using that governance token as digital assets, and then the entire process. So having said that, why is that important? And this is where things become super interesting and real for financial services, the non-banking financial services. So many of you are familiar with this element. I think Nikolai is looking at, but Nikolai is bankable assets. So every bank has defined business models. When you go to a bank and you ask for money, they ask you for a few things. What do you have as a collateral? Do you have a house? Do you have a car? Or what do you need money for? So if you're buying a car, then they will own the car till you pay all the money off. These are traditional risk models, business models, collateralization models that the banks can trust and issue you money, and that's how the economy is maintained. And that today, my friends, is about $471 trillion globally. But if I were to shift the focus on things that we all have value, but banks have really no way to collateralize, understand the risk models, is around things like, real estate, art, patents, certificates, and things that you and me and we all value, but banks really have no way to lend money against. And that way you cannot exactly monetize it. And get this, that if we did the math, and there was a think tank that researched into all the individuals, all of us who have things of value, whether it's tokenized real estate, whether it's art kept in our houses, the patents that we own, our future earnings is also an asset. If you all are, if let's say Nikolai and Ivan are educated people, they have a job, which means they have a prospect of getting future earnings. That is an asset that you should be able to borrow against your future earnings. Collectively, what today in a traditional banking sense is $471 trillion, that space is about $2 quadrillion. So imagine that, it's a trillion times trillion. That's how big the market is, which is not just the human potential, but all the things that traditional financial industry or traditional banking system really has no way to quantify or lend and borrow and create a business activity against it. And so the question that we are trying to answer, especially with the advent of NFTs, is the value on human attention, the value on this play to earn and earn to win type gaming models that are coming, and ability for us to not only what grid computing has done in taking underutilized value of computers, but also underutilized value of human potential and putting them to use, whether we are gamifying it or whether we are creating new economies because we have no new networks, new people joining the network. That is the fundamental thing that's behind this crazy growth and valuation of crypto industry in general. So that is the application that we are trying to go after traditional bankable asset to what has been non-bankable asset, and how do we monetize that space from a perspective of those elements. But all this doesn't happen in thin air. It's not magic. And I wrote a paper on this topic, which compares how internet evolved over time with different layers. So internet evolved with, we first had physical layer with DARPANET, and then eventually we had different layers. But it took us almost 15, 20 years before we were fully able to buy airline tickets and do banking and do interesting things. For the longest time, we were simply reading information. We were doing in Web 1.0, which what we have labeled as Web 1.0 is read information and consume information. And Web 2.0 then allowed us to participate with bi-directional communication between parties and platforms. These are Facebooks, Googles of the world, monetized at Web 2.0 because we became content creators. All the data that you see in Google is given by us, and Google is able to monetize that with their algorithms, and data became really, really important. And Web 3.0, which is where we are at the convergence of Web 3.0 and blockchain enabling it, is changing that business model to say the Facebooks and the Googles and the Amazons of the world have really monetized our attention and our time. Is there any way for us to be a participant in that and be able to monetize our time, our data, our healthcare records, and everything else that belongs to us, but we really have no control over it? And that's the messaging and thesis behind many of the Web3 elements, but it is evolving. So what you see today as layer 1 protocol is the foundational trust layer that goes with all the layer 1 protocols that are tied to, let's say, for example, Bitcoin, Ethereum, Solana, Cardano, Stellar. These are all layer 1 protocols which are trying to provide the foundational layer that specializes in something. So Bitcoin, again, is a singular function that allows you to move store of value, which is Bitcoin itself. Ethereum came in, had the basic layer of having Ether, but you also have programmability, which allowed you to have interesting business cases, which we have seen in decentralized financing, payments, some of the use cases with music, identity. Because of programmability, it gives you different layers. But when you have so many workloads on a system, just like a traditional bank would have to have high availability and have more capacity, the world computer, which is the decentralized layer, that layer 1 needed a scalability or needed additional security. That's where layer 2 began to come in. So Arboretum, for example, is a Polygon or a zero knowledge proof or rollups. These are examples of saying that layer 2 is stressed and it can only handle so many transactions depending on the scale and number of people running it in a decentralized world. Can I create innovation in layer 2 world, which allows me to do what traditionally has been batch processing, is to create either a sidechain model or be able to transact between two people, things like Lightning Network, for example, which takes away the workload from layer 1 and makes it more efficient. But layer 2 became another business model, which had its own token structure, but it still relied upon layer 1 for the integrity of transactions and some of the framework that goes with it. And then we begin to see some interesting things. ERC20, which is basically the tokenization framework, ST20, verification services, token issuance model, identity services. These are all value-add services that begin to form to take advantage of the Web 3.0 internet, which is basically blockchain and the optimization that layer 2 offers. And layer 3 has been super, super interesting because layer 3 has popped up in the last, I would say, 5 years, which has led to about $3 trillion before the downturn that we had economy of blockchain and digital assets. But my focus is on layer 4. Layer 4 to me is looking into the next generation of Amazon. So if you look at Amazon today, almost after 40 years of evolution of internet, after almost 40 years, Amazon, when you go and buy something from Amazon, it hides payments, it hides supply chain, it hides delivery, it basically has all these people doing their own jobs, and it gives you a single portal to track your packages, to look at shopping, to be able to pay for it. And behind the scenes, you have so many micro flows of payments, working with banks, working with shipping companies, freight forwarders, ensuring that you have enough systems in the play. And they expanded that to Netflix and expanded that to cloud computing. So almost after 40 years, what Amazon is a e-commerce company and a technology company, but I'm focused on which is the next generation of that company, like Baidu, Alibaba, Amazons of the world. Who is that going to be in the blockchain space? Because right now we're dealing with very, very singular projects, which is either doing NFTs or doing decentralized financing or doing lending protocols or doing something very specific in the ecosystem. I'm looking at layer 4 is something that comes in, looks at these individual layers and begin to start stitching them together to take the services and create a singular service that I can take my digital assets, go to layer 4, start doing things like lending and borrowing and yield farming, which are some of the services that begin to come while the layer 4 begins to source these things. I would recommend spend some time on this chart, and I'll share the slides with Olga, and they can share with you, because that I always go back to as to how are these layers dependent, how are they layer stacked, whether it's and what you see on the left hand side is how the industry has made money. How do people make money from tokens? Of course, there's a token-based model where people create tokens and you buy the tokens to use it back in the system. They use token as a medium of exchange, typical Bitcoin and Ether use cases. They do asset pair trading, which is monetizing margins, what exchanges do. Some of them are commercializing technology. Algorand and Polygon are trying to take the technology and saying, can we sell the technology as the typical software sort of suite? And then you have the power of networks, that the bigger the network grows, the bigger ecosystem you have, which is the goal of all Ethereum products in the past, but also now the Ethereum killers, the Solana, the Cardano, the Algorands, who are aiming to make a better Ethereum, which is more scalable and cheaper and faster and better. They're relying on the power of the network. I go back to this quite a bit, so spend some time on this, and happy to answer any questions at some point in this journey. But if I were to take one of the applications, and what the previous slide represents to you is a stacking, which allows you to stack how technology is stacked. But if I were to take one of the applications, which is decentralized finance, if you look at it, it has its own stacking, which means decentralized finance relies on a settlement layer. Settlement is something similar to what you use euros, rubles, and dollars to eventually pay for things, and they provide you a unit of exchange. They give you medium of exchange, unit of value. And Ethereum, Bitcoin, layer 1 protocols essentially do the same thing. You can take Bitcoin and go to any ecosystem or Ethereum and exchange that Ether for anything else on the digital, as similar to what you do with dollar, euro, yen, and likes. You can take these globally recognized currencies and go and exchange for anything in the world, and that's recognizable currency. And we begin to see that now with Ethereum and Bitcoin, that if you have many of Ethereum, Bitcoin, Solana, many of the top 15 or top 10 traded currencies, you can go anywhere in the world or anywhere in the digital ecosystem and exchange them for any other token, which allows you to participate in that ecosystem. So that we call a settlement layer. Second thing is digital assets. These are crypto native assets, the ERC20 tokens, the non-fungible tokens, the fungible tokens, stable coins. So any of the ERC20 projects, USDC is an example, which is a stable coin, and you begin to see, Aave, which is now has moved to, they all have the tokens, and the token either gives you a right to participate in the ecosystem, or token gives you like a stock that you own ownership that allows you to make decisions as the network tries to make changes, tries to do a few things around that space. And then you begin to look into some more creative, DeFi application that's relying upon the availability of these 12,800 different assets that are in there. Can I start doing exchanges? So you have decentralized exchanges. Can I take my token from one ecosystem, collateralize it, borrow against it, and use that money for something else, which is the collateralized debt position, or CDPs. We look into liquidity derivatives. So can I put my token into one thing, borrow against it, and use that money to buy something else and borrow against that? And that has been very, very prominent in the space, that you can do this in real time. And this gives you the ability to take advantage of the markets. But of course, there's risk with everything else that we talk about. But that has enabled the true digital interaction for us to move assets back and forth. And then you have the niche and sophisticated services, which is what I'm focused on now. Is if I create a DeFi fund, just like a mutual fund, what does that look like? Who is responsible for custody? What is the regulation? Do I need to get into the whole elements? Can I do yield aggregation? Can I go and find the best markets? Because unlike traditional markets, you don't have to be in the country anymore. Blockchain represents nation state messaging around this whole thing. Can I then go and again and be able to look in this digital realm and find the margins in each of these tokens and make the mess. And FTX, the Sam Baker-Field guy, he did that. That's how he made the first 20 million. Is simply looking at the arbitrage opportunity of how Bitcoin is trading for in Japanese market, US markets, and simply taking advantage of the price difference gave him the first leg to be able to make enormous amount of money from that perspective. So it's important to, and you cannot understand this more sophisticated models till you understand this layer, till you understand how the technology stacks up, till you understand what, again, how are these layers valued. To me, layer 4, like Amazon and Baidu, Alibaba stocks, are today more valuable than, let's say, Linux, which was valuable when they were coming. That most operating system and technology companies are not as valuable as the layer 4 protocols, but they actually are using technology and delivering value to the end user. I'm trying to find those in NFT space, in DeFi space, in centralized financing space, and how is the bank trying to adopt this model. And what you see in the vertical are traditional equity companies, things like TRM Labs, Chain Analysis, Luca, Luna Crush. These are companies who are trying to provide services that makes it easier for all of us on this call to make sense of this technology, to make sense of this markets, is what is leading. And I'll give you, after this presentation, show you a few examples that I evaluate in terms of the strength of a project, strength of a token. There are some tokens that I know, for example, Dogecoin is a perfect example. It doesn't do anything. There's no development that has actually happened for years, and yet it has a high valuation. Well, to me, I question that. I question, regardless of what Elon Musk tweets about it, whatever we do in this world should have a value and utility for all of us. And there are a few ways to determine that, which I'll share in some slides to come. This is the part 3. So now that we know what is asset tokenization, now that we know we can stack them and understand how one layer is dependent on the other layer and what is the underlying technology stack it's running on, I like to look at the new infrastructure, the new instruments, the new markets. And we looked into this and saying, from our perspective, can we look into digital foundation and market infrastructure, settlements? This is all our existing world's problem that we are trying to solve. Can all this be done with some projects that are happening already, and what are the opportunities for new projects? So what you see here in this headlines, the digital token foundation, understanding the technology that can provide smart contracts, it can provide scalability, token infrastructure. What is the market's infrastructure behind it? Do I deal with centralized exchanges like Coinbases and Huobi's of the world? And do I deal with Uniswap, SushiSwap, PancakeSwap? One is a decentralized exchange, one is a centralized exchange. They provide the same function of exchanging digital assets. But what is the advantage of using one or the other or both? Then we look into compliance, because at the end of the day, as we were discussing earlier, we hear this news on a regular basis in terms of one country banning this and banning that. We have to still make sure that we are doing the things that are in a compliant manner. And at some point, digital asset custody, somebody has to keep your assets safe, because not all of us are experts in key management. And that's the biggest hurdle, in my opinion. But also, unlike traditional assets in security and capital markets, where you're keeping the paper-based assets safe and you're relying on parties, the assets never are with you. The assets always live on the blockchain. All you have with your keys is a claim of that asset. And that mind shift of saying that asset always live on the blockchain, and with the key, you can claim it, changes the definition of what a custody should be. So some of these challenges is something which we are trying to figure out from the layer 4 perspective. And I'll tell you this, like, for example, this is something that has transpired last year or 2020 and 2021. Until that time, Bitcoin was a bad word. When I started the journey in 2013, 2014, now every single large bank that you see, JP Morgan, Goldman Sachs, and MasterCard, Visa as a payment companies, PayPal, as a payment company. And again, I work with some of my clients in Russia. Sberbank has done some amazing work in understanding the space and figuring out as to how can they provide these value add services in a compliant way. So this to me is a picture. In last 2 years, these companies and more have spent about $40 billion in trying to understand whether they're making investments directly in buying technology or making investments in an area which allows them to be able to go into the space and capture some of the elements around making co-investments and utilizing technology to be able to offer some level of exposure and services to the client base that they have. This is my team's work, and because we're a tech company, it becomes one thing. I will tell you this, whether you're a professional or you're a startup company on this call, the hardest thing that you will have as a blockchain professional is try to explain a perspective to your bosses, because oftentimes it's a business that's running and you have to explain. So I had to explain as to what is the perspective that we need to have. And I have 3 I's, which makes people understand this better. The first I is infrastructure, which is what do I need, whether it's a blockchain infrastructure, the on-ramp, off-ramp, digital asset custodies, key management. These are all technical infrastructures you need, which makes things simple for people to understand that it's not just a wallet that I can go and connect and start trading, because most businesses don't just trade. Individuals do and investment companies do, but we have a business to do with blockchain, whether it's trade financing. What is the infrastructure needed to participate in that a public network, or do you are creating a private blockchain? Whatever the case is, you need to figure out the infrastructure. Second thing is instrument. And this is an interesting conversation that I've had with many of the banks, because a token is a token is a token. An ERC20 token can be a stable coin that represents fiat. ERC20 can be a token that is a container. ERC20 token can be a gold. ERC20 token can be a healthcare record. So the question is, if a token is a token is a token, how do you treat them separately? Because to the system, all tokens looks alike. And so what we're trying to do is build on the audit infrastructure, post-trade settlement infrastructures, is keeping swim lanes that in future, which is the vision that many of us have, that the next generation that comes into, and this is my son's generation, they're already doing it. And PayPal acquired a few companies in that reason. The vision is you'll have a wallet, and the wallet will have your traditional payment instruments like rubles and dollars, and I'll have that in my wallet. Venmo or PayPal will have that in your wallet, and you'll use that to spend at buying a coffee or whatever the case is. But in future, which actually today is true, PayPal lets you keep your Bitcoin and your Ether and your Litecoins in your same wallet. And in future, I can keep synthetic securities. I can keep a fraction of Tesla stock or fraction of Nord-Nickel stock, for example, and keep it in my wallet. And when I go buy coffee, I should be able to use them interchangeably. So if I don't like Tesla stock, I don't care for it, and I want to buy a coffee with it, I'm okay. Here's $3 worth of Tesla stock. But behind the scenes, that's a capital market transaction. It's not a payment transaction. So you have to convert the Tesla stock into the fiat and use that fiat for doing payments. All that complexity should be hidden. And today, our generation, we need to have a banking for payments. We need to have our retirement funds with our investment banking. When we need to buy a stock, we need to go to a brokerage firm. Very, very complicated and fragmented infrastructure. Imagine you could do all this from a single wallet and allow you to be able to, and that's the vision that many of the companies have. So instrument is exactly understanding what is a token, what does it represent, what does it give value? Because if I'm using it to buy something or using that to exchange value, then both parties should understand what it means for that valuation mechanism. And of course, there's demand supply curve in exchanges, but that's where the market is heading, and we need to figure out as to what role we all play, whether you're a technology company or whether you're a hedge fund manager or whether you're a startup company. How do you figure out that delineation and make it simpler as the application comes? Which is, again, think of my example of Amazon and Alibaba and Baidu. The future of the layer 4 companies is what are the layer 4 companies that can stitch these things together and make it super easy for the consumers to understand. That's where things are. And then you have intelligence, which is the last I, which is you using AI and machine learning. And one thing I've said that everything in blockchain is almost instant. The question that we should be asking ourselves is, if the world is moving towards real-time movement of assets, then what is the infrastructure needed for real-time fraud? And we have seen that most financial crimes takes 3 months, 6 months, 1 year to solve. But most of the crimes that you hear about in ransomware or Bitcoin or any of the networks is almost caught within an hour, because people would know, or almost less than an hour, as to where the fraud is, and you're able to recoup money because you're able to pinpoint. So there's transparency of blockchain, and what we look into provenance gives us enough insights into figuring out where the crime is happening in real time and go after it in a digital way. So these 3 I's to me give me a chance to explain to IBM executives and our clients in terms of where should be our focus, where should be our energy. And of course, we being a technology company, we are focused on infrastructure and intelligence, because we are a technology company focused on the HSMs and what we do with our systems, and we also have AI and machine learning. But we understand what instruments do with financial services industry, and that's the perspective that I have come to bearing in in that point of view. And this is, again, some of my team's work as a part of the whole element around it. Something else I want to talk about, right? The notion of the process of converting is asset tokenization. The business is the understanding the exchange vehicles. So if you're in digital asset tokenization business, you have to figure out as to what business you're going to be in. Is the business a part of exchange? A business a part of valuation models? Is business providing liquidity to these tokens, which is what many companies have made their business models. So it's not just technical, it's business challenges around swaps. That is the business around asset tokenization. And the disruption, again, is, we discussed that earlier, of fractionalization of ability to own a small instance of a large assets, ability to be able to collateralize it, solving the inefficiencies of moving asset classes between multiple infrastructures. And I think that is the disruption. And that disruption is leading for banks and financial institutions supply chain to make a more investment, which means that for all of us on this call as professionals, it's an opportunity for us to monetize the space, but also understand the disruption that we are trying to consume for us to monetize it. So what we did, as I mentioned, I'm also a research analyst for one of the hedge funds or crypto hedge funds. I looked into the traditional area of trend analysis. So you have technical indicators for every stock. You look into the trend, volatility, and momentum. Because there's no open and close in the crypto markets, we look into exponential moving averages. We look into volatility of these tokens, which is high, low, close, at a given point in time in a window of the assets. And we look into momentum. Momentum is relatively strength indexes. What is the differential between open and close, the delta between open and close? That defines the momentum. It's not just about the price, it's about the actual value of these tokens. And we applied this to find a valuation mechanism. And if there are 12,000 tokens, just like in our real world, when petroleum goes up or down, it has impact on travel and tourism, it has impact on airlines and logistics, and the value of those stocks, because there's dependency on it. Similarly, during COVID, we've seen reduction in early days, prices increase in healthcare. So there's a dependency between healthcare and healthcare industries with food industries and so on and so forth. So we tried to, and this looks like a crazy chart, but we took about 92 currencies and looked into saying, what is the correlation between each of those currencies? Of course, this is too busy a chart, but if you were to put them in different classes, so I have layer one. So we have Web 3.0, which is decentralization of compute, storage, interconnect. We looked into layer one protocols, which is Bitcoin, Ether, Solana, Cardano. We looked into NFTs, we looked into base assets. And we did correlation analysis. And, which means that if you're doing a lot of NFTs needs a lot of storage, NFTs needs a lot of compute. There has to be a strong correlation between the Web 3.0 infrastructure, which is, again, decentralizing storage, decentralizing compute, decentralizing interconnect. What is the correlation between that industry, which is evolving in this space? That's what we try to do here. It's an ongoing exercise, but we first had to understand the classification, which I'll show you in a minute, understand the technical indicators as one of the metrics, and looking into this element around where things are. So this is an example, and I'll quickly showcase you my classification of how I do this every 3 months, look in the entire industry, find more valuable assets. I have classification of Web 3.0, layer one, layer two, lending, NFT, stablecoin, decentralized exchanges and capital markets, interoperability, asset management, derivatives, content, data management. And then I have this miscellaneous. There are about 13 to 14 categories here, and they all have a different strategic fit. So once you classify these things, then you look into, what is the research metrics that I need to, and this is a data pyramid, as how much data do I collect? And how do I map the data? And I build a research framework that looks into classification of these assets. And once we classify the assets, I look into some of the fundamental analysis of some of these areas, which is looking into investment sort of matrix, and adding those into research metrics. I look in technical analysis, which is typically what every stock entity looks into. I look into fundamental analysis, which is how many accounts, how many storages, how many the moving averages, what is the relative strength index, what is the sort of the simple moving averages, for example. I look at financial metrics, and we come up with a metric that allows us to be able to sort of come up with a model, and I then look into, hopefully you can see my screen. I look into things like these social indexes. So this is something called Galaxy score of every token. Is what is the social intelligence? How much people are tweeting about this stuff? I look into how many, what is what we call as the multi-factor indexes, which looks into here's the one that I use this. I know the founders of this company, so I use them quite a bit in terms of overall rating. This is a rating mechanism. It looks into liquidity, sentiment, volatility, momentum. It has 8 factors, and based on 8 factors, they allocate this whole thing. I also look at what many people would look at crypto meso. So if I look at, for example, what is the activity happening on, let's say, 0x, which is exchange? Well, this is concerning to me, that if you look at the value of 0x, we can look at the value of 0x at one of the other ones. So let's go back and look at 0x. The value of 0x is today is tied to, it's a $556 million market. And the value today is 55 cents. If I'm looking at that and I'm looking at this, I have 2 commits that happened in May of last year. And since then, there's been no development effort. And there are 72 contributors. Well, that to me is a red flag, because right now, that's a problem, because there's no development happening. There's no community behind it. So what gives the token a value? But even though it's doing a few things, what is it? And I think I look at Doge in the same breath to say, hey, Doge now has, because of Elon Musk, they have 100+ contributors. So now the latest development Doge was in October 19, and they have 2, which is a positive sign. And you see some of the, the higher network BTC, for example, Bitcoin is still, but Bitcoin is more mature. It has about 3,000 commits, 100+ contributors. So it's still very, very active, right? So I look at for these to say, I combine to see how much software development work has gone into it. Besides purely financial technical metrics, I look into the social sentiments. I look into the typical analysis of profile and markets, and what is a typical valuation of those metrics. For example, this overview will give me the valuation of these things and what exchanges it's on, any news around it. I combine all these factors, which allows me to be effective in understanding the valuation mechanisms. So that is a short, and I just build a short portfolio every now and then. I'll build a portfolio, I track the portfolio. I look at all these different metrics and I say, this is what the portfolio should be. I do this picks. I compare them with the top 20 of, the coin market cap or CoinDesk and some of the indices that are coming up. And I compare them to see if I were to be a fund manager, how do I rank up and stack against these indices. So with that, I'll stop. I like to actually get some interaction from you all to see if you'll never get back this 1 hour of your time, if it made sense or if it's beneficial, and happy to answer any questions that you may have. So Olga, I'll open for Q&A if that's okay.
Great. First of all, thank you for an amazing presentation. As always, it's so interesting to listen to you. And let me ask our colleagues if they have any question. Коллеги, у кого-то есть какие-то вопросы к Нитину? Можно в чате, можно задать самому. Дайте знать, если у кого-то есть какие-то вопросы. Nitin, anyway, while we're waiting for some other questions, may I ask you my question?
Sure, go for it. Yeah.
Can you see the difference between more interesting implementation cases for tokenization? I mean, for example, for some different gears, like in United States, most popular this case, in Europe, this case, and something like this.
Yeah, so some things are global, only because we have global problems with them, like payments, for example. It's very, very global, right? Because everybody has a payment problem. It takes time, it's slow, and somebody's taking commission. I'm paying 8%, I'm paying 10%. So payment issue is a global problem, and payment industry in generally is becoming, a issue. What we begin to see, interestingly enough, is that US and Europe has a very developed capital markets. The ability for any individual who has a job and who's educated to get a brokerage account and make investment to stock and bonds and some of the companies is easy, right? It's easy for even you, except that, for you to buy foreign stocks, it's a little bit of hoop that you just simply go and can't buy. And most Americans and Europeans are at an advantage because many of the massive growth companies historically have been in these areas. So what we begin to see now is there is money in the world, there's liquidity in the world, and the crypto market is channeling that liquidity into either the crypto assets, which is again the Bitcoin, Ether, and many of the derivative assets in Aave, and so they become what we call a crypto capital markets. And some of the projects like Terra Labs, who are trying to tokenize these synthetic assets, which means they can create a token, they can still hold Tesla stock in some custody and create token, and which means a Vietnam guy in Vietnam, or a farmer in Uganda, or let's say a middle-class school teacher in India is able to invest in Tesla stock or a fraction of real estate. And we begin to see a massive growth in that space, especially from tier 2, tier 3 cities in these emerging economies, Philippines, Vietnam, India, Pakistan, Afghanistan, because they simply don't have access or the capital that they need to open an account. And this one gives them direct access to a truly global platform, which brings them at par with someone like me or you, who may own one Bitcoin, and yes, they may own a fraction of Bitcoin, but we both are participating in the same economic system, which is very, very difficult for Filipinos and to participate directly in the US ecosystem because of things like, KYC, AML, and moving money. And if you only have $100, no one's going to open a brokerage account for $100 because the cost of buying a stock is so high because you're dealing with 5 or 6 investment banks. You're removing all that from this ecosystem, and that sort of levels the playing field for ability for any middle class and emerging economy players to participate in a truly global economic system. And we see those use cases really, really rampant. We've seen that with Axie Infinity, ability for Filipinos to be able to say, hey, we need to make an extra income. We have seen 8,000% increase in layered. These are smaller cities in India and Filipino, which no one's heard of. The highest amount of signups for crypto wallets are coming from these unknown cities because a lot of middle class people see an avenue for them to grow into that ecosystem, if that makes sense. Does that make sense, Olga?
Yeah, thank you. Any other questions?
Okay, and if not, then I'm hoping you enjoyed it, and connect with me on LinkedIn, take the conversation there. I also have a podcast called Beyond Bitcoin. Listen to it. Give me your feedback if you want to speak about something. I think collectively, it's still, I think that industry is still in its infancy, which means it has a long way to go. So it's never too late, and don't be confused with all the news and all the clutter. Understand the basics first, which is, I still try to do that. I can't keep up with all the news, which is very, very difficult in the space. But pick a technology, pick an area that you're interested in, that you understand, and start there. I think that would be interesting. I think I got a question here. I'm sorry, I didn't quite understand. Do you help banks integrate blockchain? Yes, we do. As a part of IBM, 90% of World Bank are our customers. And again, some of the work that I have done in the region, in what we call as Central and Eastern Europe and Russia, is understanding the banks on few areas, right? Of course, not all banks are the same. Oftentimes people get confused with the term bank, but retail banks are interested in payments, are interested in cross-border payments, are interested in the value of USDC, which is the US, the Circle digital currency and central bank digital currency and stable coins as a payment instrument. But the banks are also interested in trade finance, especially in some of the banks that I have worked with in Russia are interested in. So we do help banks in understanding a few things. Understanding the regulatory and compliance framework. It's not only about technology. Understanding the swim lanes they need to maintain, the reporting requirements. How do you extract information from the blockchain networks? We help our customers with technical infrastructure. For example, you have a liquidity management, cash management systems. If you're going towards the new stablecoin and central bank digital currency, you have to integrate them with the existing systems, because these systems are old and they are critical to banks, and they cannot just do away with it because blockchain is cool. You have to provide integration between the old and the new for it to go through in parallel. And so we help with that. We help with integration with existing systems, or at least creating systems that allows for reconciliation with cash management, treasury management systems. We also advise on security, because cybersecurity issues are very, very huge. Simply the fact that you're moving digital. And we hear all the time, and banks need to have the right infrastructure, both from monitoring and reporting, but also safekeeping of these digital assets. So those are the few a handful of things that we do in helping bank integrating, whether it's a private permission blockchain models or participating in the public blockchain infrastructures. So I'm hoping that answers your question, but happy to take on a follow on.
And we have two more questions from Artem. Artem, can you ask a question now?
Yeah. Hello, Nitin. I have a question for you. How do you think central regulators can affect DeFi and blockchain in general? And what threats to the development of this industry can cryptocurrency bans bring? Thanks.
You said central banks? Is that what you mentioned, Artem?
Yeah, how central bank?
Yeah. So we're doing two projects now with Bank of France and Bank of Canada in this picture, right? So a few things on this, Artem. It's a great question, and it's something that I think we can do immediate terms in solving the problems. So if you look at the entire cycle of syndicated loans and, for example, bond payments and movement of money in exchange of bonds, which are debt instruments, sometimes these things take 6 weeks simply to be able to transact and move bonds and receive payments. And some of these bonds are issued by the central actors, which is the government issues bonds, or you have corporate bonds at the level where central banks need the visibility because they are dealing with high quality liquid assets, which is what banks maintain. So banks have to maintain either cash or high quality liquid assets in terms of government bonds and government securities as a way to show that they're solvent and they're resilient in the event of a crisis, and they have enough liquidity to stay in business. And oftentimes the amount of time it takes, so if you imagine if you're dealing with hundreds of millions of dollars for bond payments, and that takes about 3 days or 6 days, there's a massive cost to banking industry, not only of the middlemen who are involved in keeping that liquidity, but also the liquidity hit the bank stake. So if banks are expecting $100 million payments and the payment gets delayed even by a day, that's a cost to the bank, not only cost of borrowing money to make up for the 100 million, but there's an expected impact on your treasury and balance sheets of that money. And so what we're looking into building a permission blockchain layer for that, which includes all the banks and all the central banks on the same ledger, allows us to do instant settlement of these massive amount of sort of payments in exchange of these bonds, but also have a visibility of who really holds these debt instruments, and are these debt instruments high quality liquid assets, which is required as a central bank function to qualify the solvency of a bank. And we have done that again, several projects that you may have seen recently with Euroclear and Bank of France with ECB. Recently, the Jasper project in Canada has gone into the whole thing. I think US is way behind from some of the projects. The first project that I did was again in Singapore with Ubin. But the objective of all of these things to understand two things: resiliency of technology, which has happened a lot lately with payment systems going down, but also systemic risk, impact of systemic risk. And this is not just technology risk, but systemic risk of instant payments and instant movement of money, because what is the impact of doing that from these systems point of view. So I'll stop at that. A lot to unpack there. So Artem, I'm hoping that answers your question.
Yeah, and one more question in chat.
Yeah, Anas, so how fast the DeFi sphere in America developing now? DeFi is growing very fast in Russia, new ecosystem. Brilliant question, Anas. I think to me, between DeFi and NFT, I mean, if you look at the DeFi Llama, for example, and many of the DeFi projects, the massive value locked, and I think it has gone down a little bit, but it's not because of number of tokens, it's because of the fact that we're valuing these tokens in USDs. So the valuation has gone down, but not token themselves. So I think that we have seen 3-digit, like last year, I think we saw a growth of 230%. We expect to see a triple-digit growth again for the next few years in the DeFi space. And it is growing fast in Russia as well. I think it's a global phenomenon only because of the ease and the use that is trying to go. The analog in the banking system, another brilliant question, Anas, is that the analog, two things, right? One is the banks are figuring out how do they tokenize ETFs and tokenize securities. But remember, there are 6 or 7 different entities in capital markets who are involved as we buy and sell securities. And the market infrastructure is, in my opinion, the biggest impediment. The existing market infrastructure is the biggest impediment to dealing with tokenized securities. But what most financial institutions have begun to now do, which is my conversation with the Wall Street and some of the banks, is understanding and taking part in the DeFi. So no longer we want to fight the system. We want to say, what can we do to keep the digital asset custody, to be able to look into liquidity pools, to get the high yield exposure. And this is all driven by institutional exposure sought by investors. Like all of us, we have our own sort of investment entities to say we need exposure to Bitcoin, we need exposure to DeFi. So the conversation right now is happening around risk models. And so I have a risk model framework that I have built. From that perspective, I think some of that, and I have documented this piece. This is a risk model framework that addresses some of the risks that we go into this. So right now, the existing banking system is looking into risk model frameworks of these assets. What is the risk? What is the spread? Is it market risk and some of the other elements? But I think, in my opinion, at least, Anna, that the industry has stopped fighting the system, and they're trying to figure out as to how can they take advantage of that growth. And legislation, I agree. I think US and Russia are in the same boat. We are still slow, though. I think Singapore, Europe with MICA and WASPs have given a much better guardrails for directions. India has recently reduced the union budget, which bans payments, but it allows for trading. And that's a huge, huge, huge thing that I can understand why payments are always restricted, because payment can go into FATF and some of the other, every country needs to keep a track of payments for counterterrorism funding and so on and so forth. But for trading digital assets, many jurisdictions are now opening up to say we'll allow trading because it creates new economies, new talent, new infrastructure. I think US is heading in the same direction as well. I recently heard about the Russian legislation. I still need to fully understand it because I'm hoping this is a legislative process which takes a little time to understand, but I think it'll be a mistake for any country to outright ban it. I think we should understand it, understand the risk, and go with it. I hope that answers your question, Anas. But again, a lot to unpack with that question that you asked as well. Artem, you had a question?
Yeah, Nitin, I have another question. What do you think about Bitcoin and Ethereum ETF funds? How do they affect to the prices of the first cryptocurrencies?
Yeah, more than mutual funds, I think the futures are the one that is affecting the price. So I don't see the reason, the value of ETFs for a singular asset. So I'll give an example. If I have an ETF for IBM stock, why do I have an ETF? Why can't I just, because IBM is a tradable asset. So ETFs make sense when you have baskets of assets and it has thematic investment elements. So I don't quite understand, though I think it's a need, it's a necessity for Bitcoin ETFs and Ethereum ETFs, because those instruments are understood. So when you package something as an ETF, it requires certain market data. It consumes the information that traditional ETFs are meant to consume. I'd rather own the BTC and ETH from spot markets than own ETF, because I'm paying some fund manager, I'm paying for exchanges, I'm paying for all the cost structure that goes with establishing an ETF and fund manager. I think takes away from the reason why we are here, which is ability to decentralize and remove intermediaries. But ETF's structure was created mostly for institutional investors because they understand that they have the risk models for it, and most companies were able to create the fee structure around it. But to me, it's a short-lived thing that if you do the right capital market structures, that ETFs become an. But to me, the price, the reason why the futures, which is what you see with SIBO and some of the instruments from a futures contract perspective, future contracts like a betting market, right? It captures the tendencies and ability for them to be able to create the models and go. The future markets is a much more better indicator of the price of Bitcoin and Ether as digital assets than ETFs themselves. I think ETFs also consume the same information that goes into valuation of ETFs from the futures market. I'm hoping that answers your question, Artem.
Yeah, thank you.
Somebody else raised their hand. One more question.
Yes, Nitin, I have a question. First of all, thank you so much for your presentation. It was really exciting. I have a very short question. You mentioned that the hardest thing is to convince your bosses why we need blockchain. And then you show all these tools and research instruments which you are using for your hedge fund portfolio. So you have only one sentence to reply to the investors. Why do we need blockchain? What would you say?
I would just say that, yeah, that's a great question too. The reason why I say that we need blockchain as a technology underlying platform to future-proof the future infrastructure, which means that I talk about the fact that we are future-proofing for tomorrow. So use it as a technology infrastructure, that ability to open up for new markets. And when you start today with that, allows us to be able to future-proof our infrastructure for moving from digitization to tokenization. And we have digitized the banking system by mobile apps and by the payment systems. But when you move to tokenization, blockchain will help you future-proof that trend. And that's where I start with, if that makes sense. But I do have a drop, guys. I'm hoping this was beneficial. Thanks again for your time. Connect with me, chat. Let's take it to the community, and we all are going to make it, or as we say, WAGMI in our communities. We have to start, think, innovate. So join me in that journey. But Olga, thanks again for the invitation. Appreciate
thank you so much for joining us. Thank you.
Ciao, ciao. Bye-bye.